and welcome to episode 31 of the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya,
And my name is Tamanna Surya.
and today we are thrilled to have Andrew Walker as a fifth guest on this podcast.
Hi, I feel like I should have popped in and just been like, I am Andrew Walker, and just it would have been very 60 Minutes style.
That would have been great. But before we begin, we wanted to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of this podcast.
Andrew, I've been listening to your podcast, Yet Another Value podcast, for years. I used to have this commute from Sacramento to San Francisco, and I would load up a couple of your episodes for that commute, 2 or 3 hour commutes, and I could get through 2 or 3 episodes. So I've been listening for years, and I'm constantly amazed by both the breadth and depth of your knowledge when it comes to all things financial markets.
Well, there wasn't a question in there, but I guess
No.
I'll just say thank you. I very, very much appreciate it.
You were also kind enough to have me on your podcast right before my book was published, and then once again to discuss Pebblebrook Hotel Trust, which unfortunately hasn't played out yet. I still think it will, but hasn't happened yet. So by way of introduction, Andrew is the portfolio manager at Rangeley Capital and has been diligently building his Yet Another Value empire, which includes his podcast, his Substack, and more. Andrew, I should have brought my cap along, the Yet Another Value empire cap that you
Yeah,
sent
that's
me.
the most important thing. Maybe I'll put it on so people who are watching this can see it.
Absolutely. So, Andrew, thank you so much for coming on, and we would love to have you take a few moments to introduce yourself and tell us a little bit about your background.
Sure. Hi, my name is Andrew Walker. As Asif mentioned, I am the emperor of the Yet Another Value empire. You can find it yetanothervalueblog.com, Yet Another Value podcast. Yeah, background. I mean, look, I don't know what you want. Would you guys like the full background from, birth story to kindergarten, or do you like where would you like me to start?
Maybe tell us a little bit about what made you start investing, when did you start, and then what drove your passion for investing?
Well, since it's your podcast and it's your time, not mine, I'll give you the full background. When I always was, my dad was a banker, and I've said this on the blog before, and I got a few emails from people who are kind of, Tamana, were much older than you, but slightly younger than Asif, but people who kind of grew up my age. When I was a little kid, we had computer time, right? When I was in first grade, like the school had
Yeah.
computers, nobody had computers at their home for the most part yet. And I got obsessed with this one game. And the reason I say this is I mentioned there was this game where you were this little cash register and you would go chomping coins, was the whole game. And it was like a math coin game. And I was obsessed with it. And the computer teacher told my parents, like, hey, everyone else is playing like these little music games, and your son just all he does is plays this game. He's the only person who plays it. He like beats it over and over again. And I put that up. I was obsessed with it. I put that up, and the reason I mentioned is multiple readers emailed me like, "Coin Crunchers is the game." So I'm not the only one. Most of the mid-30s finance people, it seems, probably caught some obsession with this game earlier in their life. But I was kind of always into numbers and everything. And then when I was 16, my grandfather had invested. I think when I was born, he invested in some savings bonds for me, and I got like $500 or $1,000 from them. And I told my dad, my dad was a banker and I was into numbers. And I remember running Excel spreadsheets and seeing how money would compound. And I was like, all right, this is the start of, I did not know the term the snowball yet, but this is the start of the snowball, right? I'm going to go save this like a good investor. My dad said, what do you want to do with it? And I said, save it. And, I think he was nudging me a little bit, and he was all proud. His son wanted to save, not go spend it on $1,000. It wouldn't quite buy a car, but you could probably have a lot of fun with that as a teenager. So he took me to his Ed Jones guy, and his Ed Jones guy was like, what do you want to do? And I was like, I want to save it. And not only that, I've been doing some research, and I know I'm 16. I'm never going to touch this. I'm going to save it forever. And, I want something that's higher compounding. And he was like, great. I've got just the thing for you. We're going to put you in like emerging market equities, right? Very high risk and the compound. So I gave it to him, and the next month I got the income statement, and my $1,000 was worth $900. And I was working, minimum wage was, at $5-ish per hour I was working for. So $100 was almost literally a week's worth of wages, kind of take a little bit out for taxes. It was a week's worth of wages. So that was a lot of money to me. I called the guy up and I was like, what the heck happened? He was like, look, markets were rocky this month. I was like, yeah, but I kind of follow it. And because I had this, I was like looking at the Wall Street Journal every day. It's like, I don't remember being down 10%, man. And I looked further, and he had charged me a 5% sales load to get into this mutual fund. I was like, damn,
Wow.
I paid this guy $50 for this. Like, that's more than one day of work. So I got into it, and first I quickly became bogglehead. I was like, I'll never pay a sales load again. And then I was like, how do you do better? And I quickly discovered one of the Warren Buffett books, and this was before The Snowball, which is the Warren Buffett biography. I believe it was the Roger Hagestrom book that I started out. I read it, I was like, this is what I want to do. Instantly knew this is what I want to do. And that was like kind of my sophomore, junior of high school. I started reading 10Ks the next year. I remember my freshman year, I'd go to classes when I did go, and I would sit in the back and I'd have my laptop and I'd literally just be reading 10Ks during the day. And I would drive to my job and I'd have CNBC on driving to my job. And I don't watch CNBC anymore, but I was in college, so I'll give myself credit. So I was just like really interested in the markets, and that's kind of the origin story. I'm sure you guys, I've burned 5 minutes of your podcast time, but that's the full origin story.
For a minute there, I thought you were going to say that he put you in Enron, which is one of the mistakes I made when I first got started. I ended up investing Enron at $35 a share and ended up selling out at 35 cents per share after the whole thing went down.
It is interesting you say that. There was, I try not to check Twitter too much, but I probably fail at it. But there was an interesting discourse on, hey, if you're young, almost the best first thing that can happen to you is to get zeroed out, right? Because you will be much more cautious of the risks, and you didn't do it at a time like, there are people today, I'm sure you guys want to talk about the markets today, and even forget today, for the past 10 years, if you had been investing in just like the most YOLO, you only live once style possible, you did really well aside from the brief blip from like late 2021 to early 2022. But if you survived that, and you probably should have been able to survive that unless you were really levered and really YOLOing, you've done really, really effing well. And, I do think there are people who might have started their careers with, hey, risk on. I mean, look, I'm mid 30s. Okay, late 30s. Let's not be generous. If you had started your career like kind of right around me, you could have just been making a living YOLOing, and you might think you're God's gift to earth and God's gift to investing. And your track record might say you are God's gift to investing. But as multiple people have told me, there are people now who are viewed as heroes who it turns out that their career has been made in one market. Tech stock goes up, the best of the best stocks go up, and random gambling kind of goes up. And if and when that ever changes, I suspect there are a lot of people who kind of think they're God's gift to investing who might be proven wrong. Now they might be proven right. We'll see. But, I do think you see some signs of that in like 2022. It's not lost to me when you see people who have great 8-year track records, and then you look at them in 2022, they were down 50%. They're like, look, we took our lumps that year, but it's great. It's like, hey, I get it, but that was the 1 year where growth didn't work and you were down 50%. Now it's awesome, you recovered. Anyway, I don't know where I'm going with this.
Yeah, no, that makes sense. I think it leads to a lot of soul searching because that doesn't happen early on, like I guess you and I experienced. So I have a follow-up question on that. So you were interested in Warren Buffett, read a book about him. So that explains the value investing side of it. What took you into special situations? Why the special situations angle, and why are you interested in that approach?
I think it's the game theory aspect of the special situations. I think really attracts me. Maybe it's the quick payouts sometimes, allegedly. I've certainly been in some special situations that do not have quick payouts. But when you invest in a company, and I'm not saying that I am opposed. I certainly have done my share of like kind of just vanilla value investing. You find a company trading for 10 times PE, and you think, hey, this is going to grow nicely, and I think it's traded for 15 times PE, and you hold it for a long term. And you can do that. There are a lot of variables that come into that. The nice thing about special situations is when you do it, you kind of get proven out right or wrong pretty quickly, right? So you do a special situation, you say, hey, there's a rumor that company A wants to buy company B. The stock's at 8. If the deal breaks, it's probably going to go to 5. If the deal's completed, it's probably going to go to 10. Now, 1,000 other things can happen between now and then. But, at the end of the day, either company B is going to get bought or they're not going to get bought. And you kind of get very quick feedback. I think particularly that's obviously a very vanilla special situation. But if you were talking about, hey, where do I think you can get real edge? The really complex esoteric special situations are often true N of ones. They're truly things that have never been in the stock market before, or where there's only very, very loose parallels. So if you're like, hey, where are you, Andrew, just some guy in literally a closet-sized office, where are you likely to get the most edge in your investing? Is it likely to be buying JP Morgan Chase? Or is it likely to be buying this random bank in Illinois that, they had a 8% loan to one customer who just went bankrupt. And now, banks, I chose 8% for a reason. Banks run with kind of like 8 to 10% tangible common equity. So if you have one 8% loan and it goes bankrupt, A, where were your risk managers? A, we might need to be investigating for fraud. But B, like your equity is probably zero. So it depends on the recovery. Like that's truly an N of one situation. And it's just more likely that a small investor without like teams of data scientists, everything, I think can like get a real handle and edge there. So long-winded answer, but I'm just going to ramble on this podcast until you guys stop me.
It's great. It's funny that you bring up game theory. I just wrapped up a game theory class last quarter, and it's been one of my favorite classes so far. And so I completely get that aspect of game theory related to special situations. But speaking of these investment strategies and approaches, I was actually curious about your process to find ideas. So do you use screens, sell-side research, or other sources for your ideas? And how do you go about unearthing some of these special situations as well that are a little bit more niche?
So I read almost no sell side research. Now I always say that, and then when I get into when I get into special situations in a company I know nothing about, the first thing I do is I'm like, hey, let me see like one sell sider just if they've got an initiation that I can like get some handle on the business very quickly. But I do truly read almost no sell side research aside from random initiations or like as a historical monument almost. Like if I look at a company and I see 2023, the stock went from 100 to 70 in a day. Well, I can probably go pull up a sell side note that covers the earnings, and like it's going to at least detail what drove the 100 to 70. When I say I read no sell side research, I'm very rarely going to be like, Tamana, I'm really interested in United Healthcare. Why don't you and I go read all the sell side research on United Healthcare today, and we're going to find the most compelling one, and we're going to buy. Like that's generally what I mean. So I don't do much of that. I think I read it dramatically less than my peers, but I'm not saying there's not a use for it. I read none of it. But so very little sell side research. Screens are interesting. A lot of people ask me all the time, hey, Andrew, what is your favorite screen? And for the past 10 years, my answer has been, look, I think value investing has evolved a lot. If you and I were born 70 years ago, we could expect to outperform the market by doing one simple thing. We could go and we could pull up earnings releases for every company and be like, hey, this company earned $5 per share and they're trading for $25. It's probably a buy, right? We could probably do that. If we were born 100 years ago, we could have literally gone and been like, hey, this company's market cap is 100 million and they have 200 million on their balance sheet. It's probably a buy. Markets get a lot more competitive. Right now, if you came to me and were like, hey, Andrew, this company trades for 8 times price to earnings, I think it's a buy. I'd say, I think you're about to get your face ripped off, right? That is something that a quantitative computer, the value factors, all this, I think that's been arbitraged away. I very much doubt that a simple price to earnings or any type of quantitative metric, I very much doubt that you're going to get good, you're going to generate alpha simply by doing that. So people say, what's your favorite screen? Is it low price to earnings? Is it high dividend yield? My answer is none. I think if you're using screens, a simple screen, alpha is unlikely to be found on a Yahoo Finance screen, would kind of be my trite saying. Now that has evolved recently a little bit with the rise of LLMs and AI. I found, especially in the past 3 months, there have been a lot, and a lot of them, and some really interesting tools have come out where you can have an AI run a screen for exactly what you want. So let me give you one example. You can go onto an AI LLM screen and you can say, hey, forget 10 times price to earnings. I want a company where the CEO in the past year has said the industry is consolidating and we want to be an active participant in M&A. And the CEO has said our stock trades for below where peers have sold for, and where the company is actively buying back shares, and where insiders own more than 4% of the stock. All right, I've just thrown a lot out there, but I combined a lot of quantitative with qualitative things, right?
Mhm.
I think that's a really interesting screen. I think that's a really interesting use of screening. So where you're using it to kind of fundamentally source where insiders are telling you something and it's fitting with your worldview and kind of what you would be most interested in looking at, I think those are really interesting use of screens. So if we had been talking 6 months ago, I would have said no screens. Recently, I think with LLMs, you can find really interesting screens that marry things that you're likely to be interested in, kind of your pattern recognition of what's worked for me historically, with signal. So I've kind of evolved a little bit on that.
Got it. So on the LLM side of it, we've been experimenting a lot with multiple models, and we've developed a prompt that's almost 2-page long at this point. So to your point about using sell-side research on, an initiation or a company that you're ramping up on, we're finding the LLMs to be quite useful on a completely new company or industry that we haven't done work on before. So that's been quite helpful.
Yeah. Other useful things that I'm just starting to experiment a little bit with Notebook LLM. And for a while, I was having a lot of trouble with uploading research into these things and having it summarized. But I have had a lot of success with upload like 5 earnings calls and tell me, hey, how has the CEO's views of the industry evolved over time? Or upload 10, upload 1 expert call, summarize the expert call, and then you read the summary. And then when you read the expert call, because you actually know what they're going to say, you can actually read it deeper and kind of have better retention than if you were just reading it for the first time. So I've found just like lots of little useful hacks alongside of it.
You're right. There was a time when I needed to get a smock check done, and I loaded up 4 earnings call transcripts for this coffee roasting company, Westrock Coffee, and had it create a podcast for me that I listened to on the way there. So Notebook LLMs has been super helpful on the research side.
I think LLMs in general have very much been changing the scope of how people invest. And I'm curious to see how that continues to progress as AI continues to develop.
No, look, again, into what we just talked about, it's a really interesting thing. 30 years ago, let's say 50 years ago, the best thing you could do to be an investor and outperform would have been to be able to run price to earnings and do like kind of basic math and understand how to break down financial statements. That's probably out the window, right? That the basic math and stuff is definitely out the window. But if you think about AI, like I could imagine a world where right now the Renaissance technologies is like literally the best performing hedge fund of all time. What they seem to have done is broken into LLMs and AI and everything kind of early. I could imagine worlds where that alpha is gone or it diminishes in the same way that if you were running the value quant screens have had a lot of trouble over the past 10 to 15 years because in my mind a lot of the very obvious value factors have kind of been arbitraged away by things breaking them into deeper, more Renaissance stuff. I can imagine a world where the AI and LLMs increasingly become table stakes and pod shops are running them in every one of their models. And in that world where AI skills and LLM skills have been arbitraged away the same way that kind of the quant skills were arbitraged away 50 years ago, what is the next edge? What are the next most important things for investors who want to outperform either institutionally or individually? You could imagine a lot of different answers. I think it's really interesting.
So what are you thinking of at the moment in terms of the next edge or where things might go? I'm
Yeah, so
curious.
I think a lot of it, I think there's a very good chance. Now, I'm going to say this, and then I think the easy answer would be, well, hasn't that always been the case? But
Mhm.
did you watch Billions, or is that a little bit too far before your time?
I've seen
I
it.
watched Billions actually.
So Billions, one of the early episodes, there's Dollar Bill, who's Bobby Axelrod's like best trader, I would say. He's in a debate with another analyst, and the analyst's like, "Look, I've done all this research. I've talked to the sell side. I've got all these thoughts. They're going to beat the quarter, and we need to buy." And Dollar Bill says something like, "We need to short this company." And Axe asks him, "Are you sure?" And he says, "I'm not uncertain," which is like their code for "I've got an inside check," right? And now his inside check was literally taking a pair of clippers and going and busting into a company's warehouse and seeing like the warehouse was stuffed with inventory, right? Now, I'm not advocating for literal MNPI, insider trading, trespassing, breaking the law, but I do think that a lot of the alpha going forward is going to come from checks and probably non-traditional checks. So I had on my podcast earlier this year the team from Pershing Square who won the Pershing Square Challenge with TSL, and I had multiple people email me and be like, I would have hired them on the spot if they were on a job interview. And what they did was they had a pitch, and they said great business, trading a little expensively, but great business. We think you can compound. But the real edge they had was they're like, look, we went to 5 industry trade shows and we talked to, here are the 20 industry people we talked to really understand the moat and to understand people were switching and to build this into our models. I think the skills of going out and kind of shaking hands and getting checks and calling up distributors and all that sort of stuff, I think the edge and the payout there actually goes up in an AI world because you're generating data points that are truly, not that they're completely non-creatable, because I call 20 people, you call the same 20 people, and maybe we'd get the same thing, but you're generating data points that no one else has, and then you can feed it into the AI model to get a much better response or output than any other AI model is going to be. So I think And what am I basically saying? I'm basically saying gumshoe investing and working really hard. I had one investor I was talking to, and I showed him a pitch, and it always remind me, he's like, look, this is a fine pitch, but I would never hire anyone who brought this pitch to me. And I was like, oh, like, I spent a lot of time. I think the thinking here is really good. What is it? And I wasn't looking for a job. But it's like, look, this is all fine, but you have nothing truly unique. You have no unique check here. Like, this is not the type of stuff I put my money behind. I need a unique check. Like, yes, you've done a nice job analyzing the 10K and looking at people's backgrounds and stuff. There's nothing unique. And that's kind of stuck with me. Like, increasingly in the world, if you're going to make an investment, you might need something that, I just said, hey, it can't be 10XP. When I do a write-up, if ChatGPT could summarize the write-up, could make the same write-up I do, and I don't have anything unique in there, maybe that's a sign that it shouldn't be an investment, right? Maybe I need to call up the IR and say, hey, when I asked him about this thing, he really clammed up, right? And ChatGPT could never get that check. So I'm kind of rambling again, but those are the type of non-traditional things I think are interesting going forward.
You're absolutely right, Andrew. We were both at the Berkshire Hathaway meeting this year, and while we were at that big exhibition hall, we struck up a conversation with their railroad folks. And I think we spoke to them for like 45 minutes, just, peppering them with all kinds of questions.
What were the names?
The names of the railroad company?
What was the company? Railroad?
Railroad, the Berkshire Railroad. The BNSF.
Berkshire Railroad. Okay.
Yeah.
I thought this was an AI startup or something.
No. We just happened to run into, I believe they acquired BNSF, right, a while ago. So they had a booth there and, had this conversation with a guy who had been worked at that company for 30 years or longer, and just talking to him about geographical distribution of the routes, everything. And it was just a fascinating conversation. So you're absolutely right.
We got the whole industry perspective as well. We got to hear about like not only the Berkshire-owned railroads, but everything else across. And the recent railroad deal also makes things a lot more interesting.
The Union Pacific and the Norfolk Southern. Yep.
Well, just on Berkshire, just as you say, it is interesting. Buffett's talked several times about missing Google, right? And one of the reasons I think he regrets missing Google is he said, hey, at Geico, we saw how much we were paying these guys to be like the top search when you had auto insurance. And I do think that's like kind of an example of the place where you maybe could get edge. Now, that's a dangerous edge, right? Because you're applying it anecdata. It's always dangerous when you apply anecdata. Like, hey, I love this product, so I'm going to go buy it. It's a very dangerous combination. But it is interesting where it says, he missed it because people looked at this and said, but he had an example. This was a internet company that wasn't just kind of built on price to eyeballs. This was an internet company where Geico was finding a monetary return from bidding up this thing. And, he's had a lot of experience with things that kind of control the toll bridge. And he could have seen Google had the toll bridge to pretty much every piece of economic activity on the internet. So I think you're bringing up the railroads as an interesting parallel into some kind of the unique insights that Berkshire and Buffett kind of get.
Exactly. I mean, speaking of these unique insights from Berkshire, I actually went to my first meeting this year, and we remember watching Buffett in Omaha, and he was talking about how the U.S. economy is like a cathedral, but with a casino attached. And it feels like at this point, the cathedral is very much being dismantled, even as that casino is encroaching on its territory. So you've talked about the market as well, feeling somewhat like a casino these days. I think your recent article, you talk about like multiple market multiples, and you ended the post with a statement about how you were finding a little bit harder these days to find value in the market. So then how do you approach investing in an environment like this? Or how are you positioning yourself?
Well, you're too young to be this jaded to think the casino is taking over the cathedral. No, look, well, I guess there's two. So when Buffett says that, and Buffett and Munger have decried high frequency investing and all this type of stuff, look, I don't particularly disagree with them, but it is interesting. They're not the first people to say, hey, it's kind of crazy that all of these math PhDs and nuclear PhDs, like the highest use of their talents is not inventing new forms of nuclear energy, but like going and figuring out how to make trading 1 millisecond faster or anything like that. It's right, but at the same time, like I do think a lot of this edge and competitiveness, it is zero sum, but it propels a lot of other activities forward. Like you kind of just don't know. I would guess AI, a lot of what they're doing with AI might not be possible with Renaissance and all these guys kind of laying the groundwork and pushing these models and having, hey, if you want to be a huge computer scientist, there is a $10 million payout for you at the end of this railroad, at a Renaissance or something. So I do think it's interesting. A lot of times things people think are casinos are actually very value accretive in the long run. You just kind of miss it. I don't know if that's the case here. When I talk about the casino, what I kind of mean is, look, Trump gets elected in early November, and you just see everything with high beta or meme stock run like crazy from early November until kind of the end of January when DeepSeek comes out, and everything that touches AI is down 10 to 20% in January. And I'd say everything's kind of flat till the end of January, flat-ish, and then the tariff war happens in March and April, and everything's just getting crushed, and then there's the pause. And since then, if you touch AI, crypto, or anything meme, I mean, your stock is just off into the races, and it has expanded. I would say the difference between last summer, November, December, January, I was still finding a lot of stuff where I would look at it and kind of just do like a 30-minute glance and be like, oh, this seems really interesting to me. It's still trading at a discount to asset value, or it's still trading at a discount to where peers have been taken out. Like, it just seems worth a glance to me. It's not happening for me anymore. Like, the recent rally has kind of dragged a lot. It's had a lot of breadth, I suppose. The market in 2023 and 2024 didn't have much breadth. It was really the big seven was driving everything. And I mean, the Russell was getting left behind. The rally recently has had a ton of breadth, and a lot of these things have kind of gotten taken up. Now, I never know. I find the hardest thing as a value investor is if a stock is at 20 and it was at 10 3 months ago, I don't know if I've ever been able to buy it, right? It's just, I've never bought a stock that's come from 20 to 10. Have I bought a stock that's gone from 30 to 20? Yeah, I have. What's the difference between the two? Absolutely nothing, right? Like, what should it matter where the stocks come from? But there's something about me, I just can't buy a stock that's doubled. So I don't know when I decry, oh, I'm not seeing value anymore. Is it because all the stuff I'm looking at has ripped over the past 3 months from the lows of April were really low? Is it because everything's ripped since April and I'm just like wedded to, 2 months ago I looked at this and it was at 20 and now it's at 35 and I can't look? Or is it because, hey, at 35 it's actually expensive? It's really tough for me to tell you. And I guess the one last thing I'd rant on here is, one of the dangerous things about bull markets is you look at a company and it trades for 10 times earnings. And you say, oh, this looks really cheap. The market is at 20. Peers are at 20. This is at half. I can buy it. And maybe, but let's say the market's fair multiple is 15. And what you're looking at is like a real dog, and it actually deserves to trade for 5. Well, when the market kind of washes out, the market will be down, in this case, 20 to 15. That's about 33%. No, that's about 25% if I'm doing my math right. And your stock that trades at 10 and, was theoretically cheap goes to 5x earnings and it's down 50%, right? So it's really tough because you can get into this, oh, it's cheaper than the market. Well, when the market washes out, it might be more expensive. And obviously I've kind of like biased the math there a little bit, but it gets tough as market multiples get stretched. You can talk yourself into buying things that are cheaper, and just because it's cheaper doesn't mean it's trading cheap to intrinsic value, right? It actually might be trading expensive. It might be trading more expensive than everything else. So I find it's a very difficult environment to wrap your head around. And I am very much aware this is the value investor's lament. I'm not the first value investor to be like, markets are up, things look expensive. I think there have been people who have been doing this since 2004. And they've underperformed, literally putting cash in a mattress since then. So I don't want to be that, but it's a hard market, I would say.
You're absolutely right, Andrew. In terms of these companies that are cheap relative to a market, especially during a bull market, I find that that's a surefire way for me to end up in a value trap. So those things that look cheap on a relative basis compared to market, I generally tend to be wary of them rather than get excited about them. So quite frankly, I'm finding it more than a little hard. And last month, I think I looked at 40 different ideas before I found one to write about. And these were not just 40 new ideas that popped up on a screen or something else. These were companies that I had on my watch list for a while. And I had to turn a lot of rocks to find anything that seemed interesting. So it does feel like things seem stretched at this point in time. So that's a great segue into a company I wanted to talk a little bit about. So I've been following Carvana for quite some time. Back when, the stock ran up over $300 a share, the insiders were selling hand over fist. The stock went down 99%. It's back up again past those highs or close to those highs. And at this point, we are seeing the Garcias, the father and the son, who is the CEO, sell once again just the way they were selling that first go around. So at this point, I think over the last 2 weeks, we've reported on $120 million in sales just by the senior Garcia. So I wanted to get your thoughts on this company. I mean, it's growing very rapidly, quite clearly, and they're taking market share. But at the end of the day, this is a car dealership, and it's not being valued on eyeballs, but seems like the market is affording it a very generous valuation. So I wanted to get your thoughts, considering you've had people on your podcast discussing Carvana before.
Sure. So, look, I guess there's so to my knowledge, I have never had a position in Carvana, so I can start that. So you're asking me, I am talking very much not my book here, right? So I'll disclose that. I think it's a fascinating company on a host of levels. Look, you have, it's a true battleground stock, right? And it's a battleground stock that's been won and lost multiple times by each side, right? In 2020 to 2021, the bull side was, completely victorious, and bears were in shatters. And then from 2021 till late 2022, the stock goes from 300 to, I'm not exaggerating, you can round it to zero. It went from 300 to zero. Like, if I'm rounding, it was down 99%. I believe it bottomed at 3. So the bears were completely victorious. And then since then, the stock, as you and I are talking, is what, 330. So it's gone from 300 to 3 to 330. The bears are completely victorious again. It's just a fascinating company to me, because it's a true Rorschach test of, you can look at it and see whatever you want. You mentioned the Garcias selling, and look, you never like to see insider selling if you're there. I guess the counter would be, look, the Garcias stepped up and funded this business when it was like on its absolute deathbed. And you mentioned they've sold over $1 billion. I mean, they still have a huge holding here. So estate planning purposes, like, if I had a $10 billion holding and I sold $1 billion, I'm sure people would be going crazy to me. And I'd be like, look, I'll probably manage this better owning 9 billion of it with $1 billion of cash in the bank account than I would with 10 billion, because I'd personally be too scared to take a swing if I had the 10 billion. And, this is a growth business. Maybe you need to be taking some swings to maximize. If you're Facebook and you're not taking swings 10 years ago, guess what? You're dead. Like, it's not that you were being cautious. You're dead. You missed mobile. You missed AI. Like, you would be dead. So maybe you want a manager who's comfortable enough to take swings. Anyway, I think the interesting thing is, the bull case is, this company has, buying a car is a very expensive, very inefficient process that has not moved out of the basically 1950s for X, Y, and Z reason, and particularly buying a used car, right? Everyone thinks of buying a used car and they think of, you go to the used car dealership, you've got the swarmy salesman who's selling on commission. There's a lot of risks of, lemon, you buy the used car and it turns out to be a lemon, you got played. There's all sorts of bolt-ons to it that adds on to the cost. So it's a terribly inefficient process. A used car lot, you think about it's taking up all of this space. Buying a used car, like just having it as inventory. If you think a used car costs, let's say $20,000, if interest rates are 5%, then every year you're paying $1,000 to hold that car in your lot. Plus, it's depreciating, right? If a car lasts for 10 years, $2,000 of depreciation on a $20,000 car. So a year, $3,000 of cost. Let's just round it and say, a year's 12 months, but let's just say it was $3,600. So every month you have that car in your lot costs you $300. So you could imagine that with a lot of tech, a newfangled company could take less space, so less real estate. They could reduce the time that they hold on to these cars, like all these ways that they could massively improve the process. You could imagine a tech-focused company could just disrupt this enormous market. The used car market is literally a billions and billions, tens of billions of dollars market. So that's your bull case, and your bull case is Carvana did all that, right? They are completely tech-focused. They've invested all of this money into logistics, and when you add up all of these advantages that they've done, they're going to take over the entire used car market, right? Like, why should they be limited with tech background? Why should they be limited to selling 20% of the used cars in the markets? Why should 80% belong to legacy used cars dealers who are inefficient, more expensive, all this sort of stuff? I don't know. Like, if they truly are better, why shouldn't they have 100% of the market? This is a market that can completely tip. There's your bull case. Your bear case. The accounting is funky. The father is literally, I believe, literally a convicted felon, right? I believe he was barred. All this insider selling, all these red flags. The accounting is funky. A lot of people don't think they make money on selling the cars. They make money on subprime loans. They make money on all this sort of stuff. I don't know. I don't know. If you got me in the room with a really passionate bull, and I have several, I talk to them for an hour, I tell you, I think this is the best fundamental work I've ever seen. We should be YOLO long this. If you get me in the room with a really passionate bear, I'd be like, yeah, the accounting red flags, the insider selling, this is a disaster. We should short this to zero. And my answer has been like, man, it is interesting to talk about and look about and think about. Obviously, I've done quite a bit of work talking, thinking. It's really fun not to be invested in this stock. Well, actually, I don't know if it's really fun because ultimately the Bears have won. Ultimately the Bulls have won, and I probably leaned more towards the bull case, just like looking at the company and like seeing the product actually work versus the bear case. So it's not hugely fun when you like looked at it at 20 and were like, man, I think my bull friends might be right, and the price is cheap enough, and then it runs to 350 inside of 2 years. But aside from that, it's been like fun to watch from the sidelines.
Yeah, so that's great, Andrew. We've been watching this. We watched it the first time around, and now we're watching the insider selling again. So a couple of points to what you were talking about. When you take a company like Lithia Motors, they are also quite profitable. I mean, the market for used cars has recovered quite well and was doing quite well for a period of time. So the traditional dealers were doing well as well. And some of the things that hurt the traditional dealers, such as holding on to a depreciating asset and having to pay interest and all of that, inventory affects Carvana as well. Maybe their turnaround times are faster, and so maybe that helps them a little bit better compared to a traditional dealer. And maybe they have, warehouses or locations that are in a significantly cheaper area than in the middle of a city and so on and so forth. So that helps them. One quick point on their buying. So you're right, they did buy when the stock went down quite a bit. We saw some insider buying like at the $8 level, which was excellent. But one of the big purchases they made was when they participated in that secondary offering they did to raise capital. And we've seen that quite a bit with insiders buying in secondary offerings, often to kind of signal the market saying, hey, we believe in this, we need capital, that is a secondary offering and we're participating in it. Elon Musk comes to mind. He participated in almost every single secondary offering at Tesla over the last several years. They don't have to do that anymore. But as they were growing, we could see him participating in those offerings.
Well, look, you said that as if it's a red flag, but you said this if it's a red flag or a cautionary sale, but it's curious you use Tesla and Carvana, which most people would have like literally chopped their left hand off to if they had the hindsight, if they could go back in time and have the hindsight to invest in any of those secondaries. So I certainly understand you do a secondary, and I get called for secondaries all the time. Yeah, it's a lot easier when you say, hey, we're looking to do a secondary, we're going to raise $100 million, and management's taking down $1 million of it, right? It's certainly easier to sell, and I get you can have the hey, this is a sales tactic or whatever. But in terms of sales tactics, it's a damn good one because you just listed two stocks that were up 20x. And look, even if they're doing it as a sales tactic, right? There's two things. A, they generally have to think that the stock's not a zero or that the stock's going to go up or that it's going to work to do it. And B, on the back end, you get this really interesting thing where even if they did it purely as a sales tactic, like we're not talking small commitments here. All of a sudden, they have just written a big check into the company. And now you might have a company where previously management team, I've seen somewhere the management team makes $250,000 in base salary, all in. And then there's a secondary and they put in $1 million. All of a sudden, their equity ownership is much more larger than their salary. Now, annuitize the salary, maybe the salary is still more important, but all of a sudden they're much more equity friendly, right? They care about the stock price. Now they've got skin in the game. So even if originally it was a sales process, all of a sudden it's become exactly what you want it to do, right? So I do hear you on, maybe it's not the cleanest. It's not they went an insider bought $5 million, but anytime somebody comes to me and is like, hey, here's the caveat for this insider purchase, why it didn't matter. I'd kind of be like, well, now we're aligned and they actually wrote the check, so I feel better. There are some caveats, like I've definitely seen some finances where I'm like, oh yeah, like this is a CEO who makes $30 million a year and he's writing $1 million check. Let's say I'm not that convinced that this is anything but a token buy. But for the most part, I would say like the Garcias were putting in real money and people would say, hey, they sold more than that recently. Cool, I get you, but I'm generally kind of skeptical of people who diminish any type of insider buys.
Got it. And that makes sense, Andrew. And that's why I wanted to pose this to you, because we wanted some pushback on our bearish thesis, if you will. It's always good to get the other perspective. Speaking of insider buying, we recently came across some insider buying actually last week at a crypto treasury company, and specifically a Solana treasury company called Upexi. I know that this is something that is of interest to you as well. And so for our listeners who are not quite familiar with crypto treasury companies and what is happening with them, could you talk a little bit about how you think about what's happening in this emerging segment of financial markets, if you will?
Man, I have to be careful. So, look, I'm looking at Upexi, and it's funny because I had a phone call with someone talking about Upexi earlier this morning. There's a lot of insider buying at Upexi. Now, what is interesting there is, again, all insider buying I tend to value, but the insider buying there was kind of done when I look at it, most of it was done in the low twos, and the stock's now in the sixes. So it's just kind of interesting there. But to back up, Upexi has converted themselves into a Solana treasury company. There's this growing wave of things, digital treasury companies. And what they are is MicroStrategy, Disclosure, have a position there, is the famous example. These are companies that trade on the stock market, and they've decided, hey, it's cool being traded on the stock market, but why don't we go and buy any type of crypto, and we will be a crypto company. And for some reason, the market has decided that a Bitcoin, you can go buy a Bitcoin for $100,000 on, Coinbase or wherever you want to buy it, or you can go buy it through MicroStrategy and pay $200,000 for it. Or, there are some that trade on smaller markets where you will pay $300,000 for it. I'm being a little sarcastic here, but the market has decided that a Bitcoin in a public market company is worth more than a Bitcoin. It trades these Bitcoin companies at a premium. I would contend that is insane. If I went to you and I said, hey, I'm a public market company and I've got $100 in cash, I think I should trade for $200. I should trade for a premium because I've got this cash balance. You'd say, Andrew, what are you smoking? If I went to you and said, hey, I'm this public company and I have 100 barrels of oil that I've stashed down the street, or 100 bars of gold, I think I should trade at a premium. You'd be like, you're crazy. For some reason, because of crypto, these companies are trading at a premium. There are parallels in history. A lot of people have pointed out in the 1920s, there were closed-end funds that basically did this with stocks, right? And they said, hey, because we rolled 20 stocks into one closed-end fund wrapper, and I'm being like a little loose with the terminology, we should trade at a premium. There weren't mutual funds back then, remember? We'll give you diversification, we'll give you capital allocation, all this sort of stuff in a box. And these things were trading at huge premiums. In my opinion, nothing that owns an asset should trade at a premium to that asset. There's lots of reasons for that. MicroStrategy or any bull of a crypto treasury would say, hey, because we can sell converts, and with 0% coupons, converts at huge for nothing, basically, they'll convert at premiums to our stock price, and we'll go use that to buy the crypto. We can do this forever. I would say, well, yes, but that's a function of your volatility, and that tends to die, right? And there's multiple ways that can die. Most likely, your volatility just comes down over time because it's very hard for a company to have 100 vol. Other way, especially as it grows and grows and grows, the volatility of the underlying can go away. Look, Bitcoin, the bull case for Bitcoin is it will replace all currency. Well, currency isn't exactly known for having a very high volatility. If you're going that route, eventually the currency can die. It can go down. And, these Bitcoin, a lot of the plays, if you look into the fine print of their KPIs and their math, they assume that the converts that they issue at, the converts at 1,000 and the stock's trading at 500, they'll assume that all of those shares will convert. I think 4 or 5 years from now, when all of these converts come due, if Bitcoin hasn't gone to 400,000 and these stocks are kind of lagging, you're going to see a lot of really interesting conversations of, oh, hey, all these companies that were buying Bitcoin at 100,000 with converts, now they need to pay off those converts, right? That debt comes due. How are they going to pay it off if Bitcoin's kind of stalled out 4 years from now? Well, they could try to raise more converts, but now their volatility's come down. They can't do a convert at 0% coupon for sure. Most likely they'd have to pay a huge premium. They can't go that route. Could they issue a ton of equity? Sure, but I doubt that there's going to be much interest in equity because the whole thing has been we can keep getting more crypto because of the convert trade. That's gone. Do they sell the Bitcoin? Well, now everybody, right now Bitcoin's getting propped up because all these treasury companies are buying every Bitcoin they see. All of a sudden you've got to rush the other way. So I guess the basics are, look, Bitcoin's an asset. That's fine. Am I a crypto skeptic? Probably. But just because you're a skeptic, like assets shouldn't trade for a premium just because they're in a public company market. And all of the arguments I've seen for why they should trade, I think ignore history. And I think they're very much bull market thinking. I would be very surprised. I would be very, very surprised unless, I mean, if Bitcoin goes to 400,000, yes, all of these are going to work, but I think you would probably rather buy Bitcoin, to be honest with you, than that. If Bitcoin stalls out or just like normalizes its returns, I think all of these end in tears, to be honest with you.
I was actually reading some of your work on these crypto treasury companies, and at the end, you mentioned a little bit about how you can take advantage of them for relative value arbitrage. For listeners who may not be familiar with that, could you walk us through that process and maybe like in the mad craze of these crypto treasury companies, where can you find opportunity?
Yeah, absolutely. So look, I will say this is high stakes, dangerous stuff, and I do this in very small size, and I do have the debate in like internally with myself. Is it even worth the brain damage? Because a relative value trade is, the classics are you have a stock, it trades in Europe and the United States. In Europe, it trades for $10, in the United States, it trades for 9. So you short it in Europe for 10, you buy it in the United States for 9, and then you collapse the two and you make a risk-free $1, right? That's your classic trade. That's kind of been arbitraged away by computers, like especially before computers. You hear all sorts of stories about the people in the 1800s. They had pigeons that were faster, and they found out that Britain won the war before anyone else did, so they could buy the British pound and sell the French whatever the French were trading on. And like that's literally a form of that's information arbitrage, but things like that. People who would get news that, hey, this company was sold. I've already explained it. I'm sure you're listening to it. Relative value arbitrage is, hey, I did the Europe and US example, but in this case, it would be, hey, you've got two Bitcoin treasury companies. One of them trades for 4 times NAV, and one of them trades for 2 times NAV. These are just companies that exist to buy Bitcoin. Why should one trade for a premium to the other? Why should any company trade for a premium to the other? Because it has better strategy, because it has better capital allocators. All of that is possible. But when you've got two companies who say our stated goal is to buy Bitcoin and hold it forever, it's really hard to say that one company should trade for a premium to another, right? Like what capital allocation are we talking about? You raise the money and you buy the Bitcoin, right? Like Bitcoin goes to 100,000, Bitcoin goes 100,000, 200,000, they're going to benefit the exact same. So it's really hard to understand why one would trade for a premium to another. Your relative value would be multiple forms. You could short the one that trades for 4 times NAV, and you could buy the one that trades for 2 times NAV. Now that's nice because you're buying and shorting premium to NAV, right? So if premiums to NAV inflate, you should get the same exposure, and you're just kind of betting that these two will normalize. Your risk is obviously the 4 times NAV can go to 20 times NAV, and your 2 times NAV can trade to 2 times NAV, and so it's kind of a dirty hit. That's one. The other that you see Jim Chin is talking about a lot is, hey, these Bitcoin treasury companies, their basic trade is we sell our stock to buy Bitcoin. Our stock trades at 2x NAV, 3x NAV. Bitcoin trades for obviously 1x NAV. That's their trade. Why don't I do that trade? I'll short a Bitcoin company trading at 3x NAV. I'll buy the Bitcoin. And then theoretically, I should profit over time, right? You're basically betting that the NAV premium will come in. And it kind of doesn't matter if Bitcoin goes from 100 to 200 or 50,000. The NAV premium should come in over time because they're doing that exact same trade, right? And it just can't trade at a premium for a while. I think it's an interesting trade. I think he's right, as you can probably tell from everything I was talking about and everything. But the tough thing with the trade is you could have started doing this trade when they traded for 2 times NAV, and some of them have gone to 4 or 5 times NAV. And when you have something when you're short something that goes from 2 times NAV to 4 or 5 times NAV, position sizing gets really hard. And John Hempton from Rangeley Capital has the famous I shorted it from 10 to 0 by way of 100. And the issue with that is if you're short something and it goes from 2 times NAV to 4 times NAV, if it was a 1% position, now it's a 2% position. You probably have to pare it back, right? So this is why I don't do much, if any of it. I debate if it's even worth my time. The position sizing has to be really small. And ultimately people ask all the time, hey, what about shorts? Do you run long short? What about shorts? Some, but as I've gotten older, as I've started to get some gray hairs up here, I just, unless you are a shop that is 100% dedicated to shorting, I just don't know if the return on time, the return on brain damage, the risk management, trading management associated with it, I just don't know if it's worth it. So I know you started asking about premium NAVs and risk arbitrage, and we got onto my gray hairs, but that's kind of my answer.
No, that's great.
I have some of those gray hairs for the very same reasons, Andrew. So the return on brain damage is always top of mind. So Andrew, this was amazing to hear you talk about the crypto treasury companies and the relative value arbitrage. There's another area that's been quite fascinating and that's making a big comeback now that we wanted to talk to you about. So you had a recent post about SPACs. and that you considered that going public through a SPAC was actually a really expensive way for companies to do this. And this is very different from the prevailing understanding that it's often cheaper and faster to go public through a SPAC. I couldn't agree more with you, having seen outcomes of multiple companies that chose to go public through a SPAC route, including a founder that I know here in the San Francisco Bay Area. Can you discuss why going through a SPAC is actually significantly more expensive for the companies? And also briefly touch upon what a SPAC is for investors who might not be familiar with them.
Yeah, so SPACs are special purpose acquisition companies. These are companies that go and they raise generally $100 to $200 million, though there are some that raise smaller, some that raise bigger, and they throw it into trusts, right? So they raise $200 million and they put it at literally JP Morgan in a bank account and say, we cannot touch this, right? And generally SPACs trade for $10 per share. So they'll have 20 million shares outstanding, $10 per share, 200 million in trust. They throw that money into trust and then they go and try and find a business. And they try to find a business that they can take public. They announce the deal. And then if you and I were investors, they would bring the deal and say, hey, we found this great deal. We're so excited to take it public. We're taking this public. Here's the deal. You have the option as the SPAC investor. You can either vote yes for the deal and get equity in the new company, or you can actually, the vote is separate from this, but you can say, I want to keep the equity in the new company, take the $10 per share that I gave you and roll it into this company. Or you can say, nah, I don't like it. Give me that $10 per share back, right? So I've been following SPACs for 10 years. I think they are wonderful, wonderful products for investors. And obviously I'm talking my book. I'm long a host of SPACs, but I think they're wonderful products for investor because you take your cash and you park it in trust and you get a free option, right? And I'm ignoring the warrants and all the other stuff. I'm just talking about the equity. You get a free option. The company comes and it announces a killer deal. And there are some companies that have had killer deals that have emerged from SPACs, right? Like him or hate him, the Donald Trump, the DJT SPAC, which did DWAC, last I checked, it was 20. It had traded for 200. Again, its start price was 10. You would have loved to have been in that SPAC, right? You could have, maybe you didn't like the deal, maybe you did. Guess what? You could have sold it for $50 or $100 per share the day they announced the deal. So you probably would have liked some aspect of it. There are plenty of other companies that have come public through SPACs that have done very well. IonQ, which is a quantum computing stock. Am I a little skeptical of a lot of pieces of it? Yes, neither here nor there. The stock has done very well. That came public through a SPAC. There are some companies that are more like dyed-in-the-wool value investor style companies that came public through SPACs that none are like jumping off, but I promise you there are like traditional good companies that have come public through SPACs. You can find a needle in the haystack. So I love when you buy it and you have access to that optionality, right? Maybe they'll announce a killer deal. In the market right now, there is CEP, Cantor Fitzgerald's first SPAC that announced a Bitcoin treasury deal to bring it back. And that's how SPACs kind of tie into the crypto stuff we were talking about. They announced a Bitcoin treasury deal. The stock went from 10 to 30, right? So you would have loved to have been there. You don't have to love being a Bitcoin treasury person. You could have sold it the day they announced it and you would have made a 3x return. I love having access to that optionality that these sponsors will find good deals. Now, that is me as an investor buying the SPACs. If you were talking me as an investor holding the SPACs through, or me as a company, well, actually, let's talk through holding the SPACs through. I love the optionality of SPACs. I do not touch post-deal SPACs for the most part. Why is that? Well, you're faced with a whole host of issues. First, the SPAC announces a deal at $10 per share. If the deal is approved, the sponsors get a cut of the deal, 20% of the SPAC equity. Now, the math gets a little complicated because generally you're buying a debt and you're buying the company and the SPAC is taking 20% of the equity in the company. So the sponsors get 20% of that 20%. So it's 4% of the equity of the company. And generally there's debt on the company. So if you look at it on an EV base, it's even lower than that. But nonetheless, there's a big management fee associated with that SPAC if a deal gets approved. Mm-hmm. But even worse than that, most SPACs have 18 to 24 months to get a deal. If they don't get a deal, the SPAC returns the money to the shareholders and the SPAC sponsors who on a $200 million deal will invest about $5 million for overhead and everything. That $5 million goes to zero. So I think you have as a SPAC investor, if you roll into the deal, you have the worst of all worlds. You have enormous expenses associated. The company that's gone public had to pay bankers and everything to run the process, get the process done. You are paying the SPAC management team, 20%. So literally PE,
Mhm.
crystallized fees, not for a successful investment, but for getting a deal done. And the sponsor was completely incentivized to get a deal done. So you have the winner's curse. You have a sponsor who put 5 million in. If they can get a deal over the finish line, that 5 million can become multiples of their money because it's structured so that they're getting penny warrants and stuff. If they don't, it goes away. So you've got a sponsor that's incentivized to get a deal done on any terms, basically. So rolling into post-deal SPACs, there's a reason they get such a bad term, and it's because you just bought a company at probably a nosebleed multiple because of the winner's curse, huge expenses. Like SPACs in general are very, de-SPACs, as they're called once a SPAC gets an acquisition done, are in general very poor performing products. And then from the company side, you are, if you go public through a SPAC, you are paying that management fee, that 4% or the 20% promo to the sponsor. There's a lot of other hidden fees. You basically ran a full merger process to get this done. A lot of times at the end, you ran it, you're paying this sponsor 20%. And then because investors like me don't want to roll into it, they say, hey, cool, we had $200 million in trust, but $197 million redeemed. So you go through this whole process. Most of the SPACs I see takes about $25 million in expenses to get a SPAC deal done. You $25 million in expenses, $4 million, $10 million, $20 million, whatever to the sponsor. And at the end, you get $3 million in trust. It's like not a great trade. So I'm generally I feel like I've been this way the whole time. Like when I first heard about SPACs, I was very skeptical of them. And I think over time I've gotten more so skeptical of them. But I think for an investor, they're wonderful, wonderful optionality.
Yeah, and you're
Makes
right.
perfect sense.
It goes on both sides. So, for example, you talked about the long side, but they also provide this wonderful opportunities on the short side, especially if you're like living on the edge and looking into this basket for short opportunities. That said, as you pointed out, there have been real companies that have gone public through a SPAC. Lionsgate Entertainment spun out of the Lionsgate Studios and merged it into a SPAC and went public that way. And then there was
I don't know if
CompoSecure.
that qualifies as a real company, to be honest with you.
The Lionsgate Studios, I think we find quite interesting. The other side of it, the stars, not quite as much on our end. Andrew, love to hear why you feel that doesn't qualify as a real company.
Oh, well, I'm being a little jokey. Look, I think Lionsgate, I haven't followed them as closely as I used to, but I think they are in a very tough spot. I think most investors, when they point to Lionsgate, point to the Amazon MGM transaction and say, look at the value of this library. I
Mhm.
would say that was done in a very different market. It is very possible there is strategic value there, very possible. But what is the value of a library today? I don't know. Like Netflix has no problem, and they've never bought a library. There's no problem with licensing. There aren't a lot of buyers. I think when you look at library, people think, oh, remakes and everything. Lionsgate doesn't have that many great properties. I don't know if the remake value is there. I don't know why a company needs to own Lionsgate to kind of mine that IP versus Lionsgate selling to the highest bidder. There's a lot of expenses associated with Lionsgate. And then I would just, the last thing is, I've owned Lionsgate in the past. I don't now. I kind of owned it, and shame on me for ever owning it. The last thing I would say is Lionsgate has had a lot of bids. And the controlling shareholders of Lionsgate, I think if you look at their track record, I think they've turned down great bids, hoping for
Yeah.
perfect bids, or maybe because they don't want to sell. And I am worried that the asset value there has deteriorated a lot further than kind of bulls think based on the MGM comps and everything. Like if they put it up today, who would buy it if they put it up today?
I think, you make a good point. I think the library does generate about $900 million in revenue right now. So it is a cash flowing asset. And I think Amazon could pick it up. You could see
Would
the
Amazon pick it
Skydance.
up? Do you think Amazon's happy with the MGM purchase?
I think so, because when you look at the original content that Netflix is creating versus what Amazon is creating, I find that Netflix's original content, and even Apple for that matter, is significantly better than what you see coming out of Amazon.
Okay,
So
but that was subjective, right? But that was
that's true.
subjective. But Amazon just bought MGM, right?
They
So
did. Yeah.
why did Amazon bought MGM, and you're telling me that their content is worse than Apple and Netflix, who, to my knowledge, have not bought a studio? So what does buying a studio solve there?
So that's the difference between having the DNA to do original content versus acquiring content, right? So that's where we are seeing that potentially Amazon, considering it doesn't have this engine to create the original content that's working that Netflix and Apple have.
But again, they bought MGM, and I don't think they've produced a single good piece of MGM content, to my knowledge. I could be wrong.
So,
And Apple did not buy anything. And I think Apple, I've enjoyed Apple content. I don't think
Same
Apple's
here.
content is like taking anyone's breath away or something. But Apple hasn't bought it. Netflix never needed to buy anything. Why does someone need to go buy Lionsgate? And if you buy Lionsgate, what are you buying? Like seriously, what are you buying? You're saying the DNA. Why can't I go to Lionsgate and offer their top 5 writers and producers $7 million each and have them come over? You're buying Lionsgate. I think you're buying a lot of legacy infrastructure that you don't need. You're A lot of people point to the library, and yes, there is a library, but how much of that library is worth a lot? Okay, John Wick franchise is very good. They've got some Rambo. They've got some other stuff. I'm not saying it's terrible, but I don't know if libraries are worth as much as people want to say these days. And there's a lot of libraries out there. Paramount's got a lot of library stuff. I don't know a lot of people who are desperate to sign up for Paramount. I think you'd be a lot surprised by a lot of these streamers if you went and looked. Be like, wow, there's a lot of great shows from the 90s and 80s and 2000s. Doesn't really move the needle. It's new content that really drives signups. Why do you need to buy Lionsgate for that? So again, I'm not saying it's terrible. I'm just saying like you look at it, you're like, ooh, there aren't a lot of buyers out there anymore. The past purchases of content like this haven't gone well. And you've got a buyer who seems to be holding out for, what is the stock, like 6 now? It seems to be holding out for $5,000 per share. I don't know if that's the best combination in the history of the world.
You make a very good point on that, Andrew, and I enjoy the pushback. And so we appreciate that. I think we have been looking at it more bullishly than maybe we should have, but it's interesting to see the way you're looking at this.
I mean, it's just my, there's everything. Like, I love media. Doesn't mean I'm right or wrong. I do hear a lot of people like Lionsgate. MGM got acquired for 8x. And 3 years ago, I've been like, yeah, MGM got acquired for 8x. Disney bought Fox. Disney's been really sad with the Fox acquisition. I don't think Amazon would do the MGM. Amazon's been rolling back a lot of these shows that they've been doing. Like, I think when you look at the overall landscape, it's really, really tough for these guys. And I kind of think they're up a creek. Echo Star and Charlie Ergen. I know a lot of people are bullish. I know a lot of people are bearish. What Echo Star did was they bought up literally 25% of the spectrum in the United States, and they just sat on it. And the spectrum might be worth infinity. Who knows? But the issue is there are only 3 buyers, and I don't know if any of the 3 buyers are interested in the spectrum. And even if they were, I don't know if any of the 3 buyers would be allowed to buy the spectrum. And with Lionsgate, like 4 years ago, everyone was desperate for content. Now, who are the buyers? Amazon, Netflix, Apple are your most likely buyers. No chance in heck Disney cares about the Lionsgate contract.
No, it doesn't.
Netflix definitely doesn't want it.
Yeah.
I don't think Apple wants it. I'd be shocked if Amazon wants it. So you're kind of left with this big studio. You're like, does a private equity firm want to buy it and throw a lot of interest on it? Seems tough. Like, what are they going to do with it? It's just a tough space.
so I think being mindful of time, I think one last question on SPACs, if that's okay. I know we deviated a lot from that idea, but I think it's interesting that you brought up DJT at the start because that was actually, I think, my very first SPAC I'd ever seen. Like the
Let's
first time I'd
go.
come across. I know. And I was shocked at the concept. I think I saw it pre-mergers, pre-SPAC mergers. So I was shocked to see like how much it had skyrocketed after. And then IonQ as well, interesting company. I think we've seen a fair amount of insider purchases. They're infrequent, but from time to time they purchase. And in hindsight, yeah, it's done great. But every time we look at the company, it just you don't we I don't know what it's running on, and I don't know why the stock keeps going up, but it does. And it's I guess that comes back to the idea of this market as a whole, maybe even the casino theory there. But in this like environment of SPACs, and obviously you're talking about investing in SPACs prior to the business combination, but how are you selecting these SPACs that you invest in? Are there specific sponsors that you're paying attention to? And then now that we're entering this new age of SPACs from like 2021, how have things changed in your process for selecting SPACs?
Remember when you said my first one was DGC, I thought you meant you own DWIC, and I was like, yes, it's
No,
10x.
unfortunately not.
So look, I'm interested in pre-deal SPACs, right? And I think there's
Mhm.
2 schools of thoughts on pre-deal SPACs. The first school of thought is you want to do a pre-deal SPAC with preeminent sponsors, right? And the best sponsors, they're not in the SPAC game right now, but they have in the past, would probably be like your giant private equity firms, right? Your KKRs, you want to invest with them because they're going to do a good deal. They've got their reputation on the line, and while it might not be a screamer, they're going to do a good deal, and they're going to get a deal across the finish line, and it's not going to be something embarrassing, and you're not going to get your face ripped off. So that's one school of thought, right? And the hope is, hey, if I buy 10 KKR SPACs, maybe I redeem 8 of them, but 2 of them will trade above trust, so I'll make better than cash returns buying these. And by the way, because they're going to get deals over the finish line, SPACs often come with a warrant. My warrant will be in the money because a SPAC that gets a deal done, the warrant, even if it doesn't trade above 1150, it'll have optionality. So you'll get that warrant value. That's one school of thought. The other school of thought is, hey, a SPAC is a call option, right? If the SPAC announces a bad deal or no deal, I will redeem and I will get trust value. But if the SPAC announces a crazy deal that goes parabolic, my upside is literally infinite, right? So you want to maximize the call option by investing in bad sponsors who are willing to do really volatile, buzzy deals. And yes, 95 out of 100 will be bad, but of the 5, right, they're just looking for buzzy things. And it's not lost on me, the DJT SPAC, there was no business there, right? That was announced because a SPAC sponsor said, I bet you people will meme the DJT brand when it's there, and we'll figure everything else out later. There's no credible SPAC sponsor, like a KKR or something, would not have touched that deal, right? But a SPAC sponsor who was more interested in playing the game, didn't really care about that multi-time reputation. They were 100% willing to do that. So the second thought is you invest in lower tier sponsors with the thought that, hey, yes, most of these deals aren't going to work out, but the 1 or 2 that do could go absolutely parabolic. They're the ones who could really catch the eye of the market. I don't have a great answer. I think it's interesting. I think my answer would be all. Like, again, they're cash alternatives to me. You buy them right, and that means not paying a premium for the SPAC. You buy them right, and then you hope one of them announces a good deal, and then you say, oh, look, this thing that I invested in for cash is better than cash.
Yeah, so no downside, but potential upside if something works out.
Yeah,
So
obviously nothing on this podcast was investing advice and everything, but that is the general appeal of SPACs.
Yeah.
Absolutely. So, Andrew, to wrap up, we have a couple of questions we asked all our guests. The first one is, who were some of your mentors that made a difference in your investing journey?
Ranger's founder, Chris Demuth, who gave me a chance and brought me on and helped me launch and everything, would be a big one. I think that others would be the kind of shoulders of giants. For better or worse, I learned a lot from John Malone, but these days I'm not sure if it's worse. It is interesting when you see like kind of a titan of industry who's stumbled over the past 10 years, and I'd say largely the Malone Empire stumbled. You wonder, hey, was he, a lot of his business was financial engineering and capital. Did he just benefit because most of his career was spent with declining interest rates, or was he really a titan of industry? I think the answer is titan, and I think his history suggests it. And the past 10 years he was older. I don't know, lots of excuses, but Malone, Buffett, all those type of guys.
Yeah, he's been trying to unwind some of that financial engineering and all the tracking stocks at this point in time. So that's been interesting to watch. And we really enjoyed having Chris Demuth Jr. as our first guest on this podcast. So that was a fun interview with him.
Absolutely. And I think another question is, are there any books that you've read? So maybe that's tied to some of the readings you've done with the people who you consider mentors, but any podcasts that you've listened to either that you particularly enjoy or found actionable advice from?
Well, one podcast, Yet Another Value podcast, has a very handsome host. I'm
Of
very
course.
biased to him. What else? The book I recommend to everyone is You Can Be a Stock Market Genius by Joel Greenblatt. This is not breaking news, I think most people, but I think in terms of thinking of, hey, how do I find an edge, and moving beyond, I want to buy things at 8 times price to earnings, thinking about where the market might be missing out on opportunity and kind of how to create a advantage game. I think that is just by far the best book for that. In terms of podcasts, I will tell you, I personally have been moving much more to listening to industry podcasts. So I'm almost talking against my book of, one investor coming on a deep dive, but I don't listen to as many finance podcasts anymore, to be honest with you. I try to listen to, like, if I'm interested in the restaurant sector, I'll find 3 restaurant podcasts where they'll have like CEOs, CMOs, that type of stuff come on and talk about what's actually happening day to day. I've been really interested in biotech, so I found industry-specific biotech podcasts where they'll have CEOs. And honestly, when they come on and they talk about the scientists, I like drool out the side of my mouth a little bit. But hopefully, I'm picking up a little bit and understanding, especially when the CEOs. Like, the interesting thing about a biotech CEO is more than any other company, a pre-commercial biotech has an operating business and a capital allocation decision, because they are either going to have to raise capital at some point to go from phase 2 to phase 3, because these phase 3 trials are very expensive, or they're going to have to sell, or if they have too much capital because they had a failed phase 2, they face another capital allocation decision of give it back to shareholders, or what most of them want to do, go YOLO it all on drugs. So it's a really interesting place where I think listening to management teams, and it's one of, I'm sometimes skeptical. I started the podcast out by talking about like literally like the hands of flesh, talking to management teams, seeing it. I'm sometimes skeptical of that because I've heard people be like, oh, the CEO is a straight shooter, and the next day the CEO like rips their face off. But the biotech one is actually one where getting a read on what the CEO is going to do is actually kind of critical.
Mm-hmm. That makes sense.
So, Andrew, we're going to wrap up the podcast at this point. Thank you so much for coming on, Andrew. We've had a wonderful time today, and it was just a pleasure recording this with you.
Yes, thank you so much once again. And that wraps up episode 31 of the Special Situations Report. It was absolutely wonderful having Andrew Walker on as our guest for this week, and we'll go back to regular programming in the next week covering all event-driven activity. However, if you'd like to access a comprehensive weekly overview of all special situations activity, go ahead and visit our website, thespecialsituationsreport.com, for daily alerts and updates on the special situation world, as well as tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.